You've been told that winning at investing is a contest of intelligence. Pick the right stocks, read the right charts, move a half second before everyone else, and the money follows the brains. The man who taught Warren Buffett how to invest spent more than 300 pages arguing the exact opposite, that in the market, the smartest person in the room is usually the one carried out on a stretcher. His name is Benjamin Graham, and starting in 1936, he compounded money at roughly 20% a year for 2 decades, about double the market's long-run average. Then wrote it all down in a book Buffett read at 19 and still calls, 75 years later, by far the best book about investing ever written. This isn't a book about picking winners. It's a book about surviving yourself, and its main character isn't a stock. It's a man. Meet Mr. Market. Because the market was never a scoreboard for how clever you are. It's a machine built to test one thing, your nerve, and almost nobody learns the rules before they start playing. Start with the distinction almost no one draws, the one Graham opens the whole book on: the difference between investing and speculating. Investing, in his definition, is narrow and demanding. You analyze the actual business, you weigh what it's genuinely worth, and you insist on 2 things: the safety of your money and an adequate return. Everything else, buying because the line is going up, because a stranger online is excited, because you can't stand to watch other people get rich without you, that isn't investing, that's speculation wearing a suit. One is grounded in analysis and patience. The other is gambling that feels sophisticated because it happens on a screen instead of at a card table. And Graham didn't learn this from a textbook. The crash of 1929 nearly destroyed him. He'd been running money for clients, and when the market first broke, he did the very thing he'd later warn you against. He decided the worst was over, doubled down on borrowed money, and bought more. The market kept falling. By the 1932 bottom, his account was down about 70%, wiped out on exactly the emotion he would spend the rest of his life teaching people to resist. Every hard rule in this book is scar tissue from that hole. So when Graham warns you, he isn't theorizing. He's the man who already made the mistake. Here's the uncomfortable part. Most people who are certain they're investing are actually speculating. They just don't know the word for it. They're not weighing value. They're reacting to price. That's the real system Graham is writing about. An entire industry of reaction dressed up as investment. So most people walk in asking the wrong question. What should I buy? The question that decides everything is quieter. What is this business worth? And what happens to me when the price starts to move? To answer that, Graham hands you the most useful character in all of finance. And Buffett singles out the chapter he lives in as one of the 2 most important ever written on investing. Meet Mr. Market. Imagine you own a stake in a private business, and your partner is a man named Mr. Market. And every single day, without fail, he knocks on your door and shouts one number, a price at which he'll either buy your share or sell you his. The catch is that Mr. Market is emotionally unwell. Some mornings he's euphoric, the future looks flawless, and he names a wildly high price. Other mornings he's convinced it's all ending, and he'll dump his share on you for almost nothing. Here's the whole secret. You are never once obligated to answer the door. His mood isn't information, it's weather. When his price is absurdly high, you can sell to him. When it's absurdly low, you can buy from him. And every other day, you can let him rave on the porch and do nothing at all. That is the entire relationship you're meant to have with the stock market. Its prices are the daily offers of a manic partner, not a verdict on what you own. Your job isn't to predict his moods, it's to use them. But almost everyone does the exact reverse. They buy from Mr. Market when he's giddy and prices are highest, and they sell to him when he's despairing and prices are lowest. They let the most emotional man in the market set the value of their life savings. And you've met Mr. Market yourself, more than once. The dot-com mania when a company with no profits could double on a press release. The 2008 panic when good businesses were given away for terror-cheap prices. The 2020 crash and the frenzy that followed weeks later. Same manic partner, new decade, every time. He never learns. That's precisely why he stays exploitable. Which raises the real question. If you can't trust the price, what on earth do you anchor to instead? You anchor to value, protected by a cushion. And this is the idea Graham places above every other. The second of those 2 chapters, Buffett calls the most important in the book. Graham names it the margin of safety, and he calls it the central concept of all investment. The rule is almost aggressively simple. You only buy when the price sits well below your honest estimate of what the thing is worth. Not at fair value, below it. That gap between what you pay and what it's worth is the margin of safety, and it exists to protect you from yourself, from an analysis that's slightly wrong, a business that hits bad luck, a market that stays irrational longer than you can stay patient. Think of an engineer building a bridge for 10-ton trucks. She doesn't build it to hold exactly 10 tons, she builds it to hold 30. And that overbuild is the entire reason it doesn't collapse the first time something heavier than expected rolls across. Buying with a margin of safety is the same move. You demand so much room for error that being wrong still doesn't wipe you out. Graham even hands the cautious investor a blunt numerical fence. Pay no more than 15 times a company's earnings, and no more than 1.5 times its book value, so the two multiplied never blow past 22.5. It's crude on purpose. A rule you'll actually follow beats a brilliant one you won't. That single insistence, a cushion every time, no exceptions, is the whole border between disciplined investing and hopeful speculation. But if the discipline is this simple, why does almost everyone fail it? Here's the story you've been sold. That beating the market takes brilliance, constant activity, a genius reading the tape faster than the crowd. It sounds obvious, convincing even. Surely the smarter and harder you work, the more you make. But Graham's entire career is the counterexample, and the story falls apart on contact with it. His model student, the defensive investor, is defined by doing almost nothing. Buy a balanced mix, hold quality, ignore the noise. And that near-passive approach quietly beats the majority of brilliant, active professionals trading against it. Not because the defensive investor is smarter, because he doesn't beat himself. Graham's point lands like a slap. The market is not a machine that pays out to the highest IQ. It's a machine that transfers money from the impatient to the patient. Intelligence without emotional control isn't an edge there, it's a liability. Because a clever person is simply better at inventing convincing reasons to do the dumb, emotional thing. So the official story has it backwards. The danger was never that you're not smart enough. The danger is that you're smart enough to talk yourself into anything. Which means the real dividing line between investors isn't skill, it's temperament. And Graham splits the entire world along it. Graham draws two doors and tells you to be honest about which one you'll actually walk through. Behind the first stands the defensive investor. This is the person who wants safety and quiet. No evenings buried in financial statements, no watching tickers all day. So Graham gives them a mechanical rule that strips the emotion out. Hold your money split between stocks and bonds, and never let either side fall below 25% or climb above 75%, with a plain 50-50 as the honest default. When stocks turn euphoric, the ratio forces you to trim. When they crash, it forces you to buy. The formula does the discipline your feelings can't. Own large, boring, financially strong companies with long records of paying dividends. And spread across enough of them, Graham says, that no single failure can sink you, but not so many that you're just buying the whole market by accident. Then, mostly, do nothing. Behind the second door stands the enterprising investor, the one willing to do real work. They dig through statements and hunt for Graham's favorite kind of bargain, the ones he called net nets. Companies so unloved that their stock is trading below the value of just their cash and inventory, after subtracting every debt they owe. Buy a business for less than the money in its own drawers, and the operating company comes free. It's the ultimate margin of safety, and it's the technique the young Warren Buffett ran to earn his first fortune. The enterprising investor waits for exactly these overreactions, a good business the market has thrown out over temporary bad news, and for that patient, unglamorous labor, Graham says they can earn more. But here's the fairness Graham insists on. Activity is not the same as skill. Simply being busier, trading more, watching closer does not make you an enterprising investor. It usually just makes you an expensive speculator. Effort without discipline loses to the defensive investor's 50-50 every single time. The enterprising path is a job, not a hobby. And most people, Graham says plainly, should take the first door and feel no shame about it. Two doors, one hinge, and the hinge was never intelligence. Because the force that empties more accounts than any recession has a name, and it isn't the economy. It's you, or more exactly, two feelings that live inside you: fear and greed. Watch how they work together, because it really is a machine. Markets rise and rising prices breed confidence, and confidence breeds more risk than you'd ever take sober. Then markets fall, and falling prices breed fear, and fear breeds the one move that turns a temporary dip into a permanent loss: selling at the bottom to Mr. Market on his very worst day. Up feeds greed, down feeds panic, and the cycle quietly taxes you at exactly the wrong moments, year after year after year. This is why Graham spends so much of a book about money talking instead about your mind. The principles are simple. Following them while your stomach is in your throat is the hard part. The market, he warns, will test your patience and your nerve on purpose. And an ordinary investor's single greatest advantage is the deeply boring ability to stay rational while everyone around them is losing it. And Graham leaves you a short list of warnings, every one of them a defense against your own emotion. Don't try to forecast the market's next move, because even the professionals reliably fail at it. Don't follow the crowd, because a stampede is not analysis. Be most suspicious exactly when a stock or a whole industry is fashionable and everyone's thrilled, because that excitement is already baked into the price and then some. And never, ever confuse a rising price with a sound investment, because price can climb for years on nothing but mood. A company can get more expensive and more overvalued at the very same time. Fear and greed are the tax. Temperament is how you stop paying it, which is the quiet engine under every page of this book. And this isn't theory that only works on paper. Graham himself compounded at roughly 20% a year for 2 decades running it, about double what the market handed everyone else. And the teenager who read his book and later sat in his Columbia classroom, Warren Buffett, took these same few ideas, Mr. Market, the margin of safety, temperament over brilliance, and turned them into one of the largest fortunes in human history. Same boring rules, wildly different century, still working. So here's the whole thing in the shape it actually forms. Most of what looks like investing is really speculation, a reaction to price instead of a judgment of worth. That price comes from Mr. Market, an emotional partner you are always free to ignore. The only safe way to deal with him is a margin of safety, buying so far below value that being wrong still can't ruin you. And the reliable way to get there isn't genius, it's discipline. The defensive investor's dull, mechanical split quietly beats the clever, busy professional, because the thing standing between you and that discipline was never your intelligence. It's your own fear and greed, which is Graham's real message. And the reason a book first published in 1949 still outsells almost every new system every year. Investing was never about being the smartest person in the room. It's about being the most disciplined one. This is not financial advice, and please do your own due diligence. So the question Graham quietly leaves you with isn't which stock. It's harder than that. When Mr. Market shows up screaming on the best day or the worst, do you actually have the temperament to do nothing? Because the framework in this one small book is only half the battle. Graham can hand you the rules on paper, but the market will spend the rest of your life trying to make you break them. So be honest with yourself down in the comments. Are you the defensive investor built to hold through the storm, or the enterprising one who's sure they can beat it? That's the thing worth knowing before you risk a single dollar.